Imagine two friends, Alex, Ben. They want to build a comfortable nest egg. They plan to retire at 65, hoping to live without financial worry. Their approach, however, takes two very different paths, dictated by one simple variable: time. Alex is 25 years old. He is just starting his career. Money is not abundant, but he understands starting early might help. After setting up his budget, he decides he can consistently set aside $300 every single month for his retirement. He commits to this plan, automating the investment so it happens without fail. Ben, on the other hand, is 40. He has a more established career and a clearer picture of his finances. Life's complexities and expenses meant saving wasn't his top priority earlier. Now, at 40, a sense of urgency has set in. He decides to take action. He makes the exact same commitment as Alex. Ben will also invest $300 each month, every month without fail, until age 65. On the surface, their plans look identical in monthly discipline. Both are making a smart, consistent choice to save for the future. The core of their stories is simple. Let's follow the money. In the first year, Alex invests $3,600, that is $300 multiplied by 12 months. If we assume a hypothetical 7% annual return, his account might be worth around $3,720 by the end of the year. The growth is small, it is barely noticeable. He has earned a little over $100 on his investment. It's enough for a nice dinner, but it's certainly not life-changing. This is where many people lose interest. The initial results of investing are often underwhelming, but the process has begun. A seed has been planted. By the time Alex is 30, after 5 years of consistent saving, he has personally contributed $18,000. His account, however, is now worth something closer to $21,500. He has earned about $3,500 from the market. The snowball is still small, but it is starting to pick up more snow as it rolls. Each dollar of growth is now also working for him, earning its own returns. This is the first real glimpse of compounding in action, where the earnings start to generate their own earnings. Now let's turn to Ben. He begins his journey at age 40. For him, that first year looks exactly like Alex's did. He contributes $3,600. His account grows to around $3,720. The feeling is the same. The progress is slow and requires faith. By the time Ben is 45, he has made the same 5 years of contributions that Alex made from 25 to 30. But Alex's portfolio has been quietly compounding for another 15 years. Compound growth is a simple concept that produces astounding results. It is the process of your money earning returns and those returns earning their own returns. Think of it like a snowball rolling down a very long hill. At the top, it's small. As it rolls, it picks up more snow. As it gets bigger, it picks up even more. The cycle repeats and growth accelerates over time. The first few feet are slow, but by the bottom it's an unstoppable force. Let's use a clear numerical example. Imagine you invest $1,000. Year 1. A 7% return. That's $70. New total. $1,070. Year 2. You earn 7% on the new total. Year 2 return, $74.90. That's only an extra $4.90. The return on last year's return. After 10 years, $1,000 grows to nearly $2,000 at 7%. In another 10 years, $2,000 grows to nearly $4,000. Same time span, twice the dollar growth. That's acceleration. Growth is not linear. It's exponential. Slowly at first, then almost vertically. Both invest the same way. A simple low-cost index-like fund. They earn the same average annual return. The only difference is the 15 years Alex started earlier. A launch pad. Once it gets going, the engine becomes exponentially more powerful each year. Let's explore how this unfolds. The decades pass. Alex and Ben stick to their plans. They diligently invest $300 every month through market ups and market downs without wavering. They both arrive at their 65th birthday, ready to see the final results. Both invested in the same hypothetical fund. Assume they achieve the same average 7% annual return after inflation. They are ready to see what discipline earned them. The results are staggering. Alex started at 25. After 40 years at $300 a month, his account is about $799,000. Round that to $800,000. His total out-of-pocket contributions, $144,000. His own money was under 20% of the final nest egg. The other 80% is over $650,000, came from the market. Earnings for 4 decades. Now Ben, He saved $300 a month for 25 years, starting at 40. His final balance, about $254,000. Round to $250,000, he contributed $90,000. About $160,000 came from market growth. Side by side, Alex has over 3x more than Ben. Alex has an extra $550,000. Alex only contributed $54,000 more than Ben, $144K versus $90K, yet he's over $500,000 ahead. That gap came from the first 15 years of investing. Most of Alex's wealth was built by money invested in his late 20s and early 30s, which had the longest time to grow. The massive gap between Alex's and Ben's final totals boils down to one powerful concept: the timeline of your investments. The money you invest in your 20s has a completely different potential than the money you invest in your 40s than the money you invest in your 50s. Every dollar Alex invested at age 25 had 40 years to work for him. Every dollar Ben invested at age 40 had only 25 years. That 15-year difference is a lifetime in the world of compounding. The earliest dollars are the most powerful dollars. They are like your most valuable employees, working the longest and generating the most growth for the entire enterprise. Think about the first $3,600 Alex invested in his first year. By the time he retires 40 years later, that single year's contribution, on its own, has grown to over $54,000. It multiplied itself 15 times over. Now consider the first $3,600 Ben invested. It had 25 years to grow. At the same 7% return, it grew to about $19,500. That is still a fantastic return. But it is nowhere near the $54,000 that Alex's first contribution achieved. This pattern repeats for every single one of their early contributions. This is why experts urge young people to start investing, even if it's just a small amount. The amount you start with is far less important than the time you start. The head start is that significant. Many people are hesitant to invest because they are afraid of losing money. They watch the news and see the market go up and down. They think successful investing requires knowing the perfect day to buy low or sell high. This is called timing the market. The evidence is overwhelming. Trying to time the market is a losing game. It's nearly impossible to predict short-term moves consistently. Even professional money managers fail at it most of the time. Fortunately, you do not need to. The real key to building wealth is not timing the market, but time in the market. It means staying invested through the good times and the bad. The market's long-term trend is upward, but it travels a very bumpy path. There will be scary downturns and exciting bull runs. If you jump in and out, you risk missing the best days. Studies show missing the 10 best days over 20 years can cut returns in half. Those best days often come right after the worst days. By simply staying invested like Alex and like Ben, you capture the market's long-term average return. This approach turns investing from a stressful guessing game into a boring automatic habit. You set up monthly contributions and let them run. You trust that over the long run, human ingenuity, economic growth, and corporate profits will drive your investments higher. It's a more peaceful, effective way to invest. An automatic plan forces you to buy every month regardless of headlines. When the market is down, your fixed dollar amount buys more shares. When up, fewer. This is dollar cost averaging, keeping you continuously invested. Reading the story of Alex and Ben can be discouraging if you see yourself in Ben's shoes. Perhaps you are 40, 45, or even 50 and just now getting serious about retirement savings. It is easy to feel that you have missed the boat, but that is the wrong conclusion to draw. The lesson is not that it's too late. The lesson is that starting now is infinitely better than starting next year or 5 years from now. While you may not be able to fully replicate Alex's outcome, you can absolutely build a secure and comfortable future. The best time to plant a tree was 20 years ago. The second best time is today. Increase the savings rate. Ben invested $300 a month, but what if at 40, with higher income, he could invest $800 a month? Increase contributions to close the gap. If Ben invests $800 a month from 40 to 65, at 7% his final total would be about $678,000. That's a big improvement over $250,000 and gets him much closer to Alex's result. Be efficient with investments. Use tax-advantaged accounts, 401k, IRA. If you're over 50, you may be eligible for catch-up contributions, which let you save more. This shields more growth from taxes and helps compounding. Keep fees low with low-cost index funds. Every dollar in fees is a dollar not compounding for you. Finally, be disciplined. You have less time to recover from mistakes. Create a plan and stick to it. Avoid chasing hot stocks or fads. Focus on steady, diversified investments. Don't try for a home run. Aim to consistently get on base. Have conviction to stay the course. Trust that disciplined savings and long-term market growth will reward you. It is never too late to start making good decisions. Investing is often presented as a math problem, but it is deeply intertwined with human psychology. The numbers and charts are simple. Sticking to a plan for 40 years is not. We feel fear when balances drop, greed when markets soar, and FOMO at others' riches. Fear and greed drive poor investment decisions. Fear is the more dangerous of the two. Selling often means locking in losses and missing the recovery. The solution: automation and simplicity. Set up an automatic monthly transfer and remove the need for willpower. The decision is already made. The principles of successful investing are simple, accessible truths. The most important one is to begin. Whether you are 25-year-old Alex or 40-year-old Ben, the path forward starts with a single step today. Do not be paralyzed by fear. The cost of waiting is higher than starting simple. Here's your checklist. First, open an investment account. Brokerage, Roth IRA, or workplace 401k. Second, set up an automatic monthly transfer, any comfortable amount, you can increase later. Third, choose a simple, low-cost, broad market index fund, or ETF. Enable dividend reinvestment to fuel compounding. Finally, review once or twice a year, not daily. Live your life while your plan works in the background. The worst mistake is to do nothing. Start today. Your future self will be profoundly grateful that you did.